Hello and welcome on this video tutorial. I am Grasilda and I am talking on behalf of Unisocial Business Albania. The presentation today is going to be on an introduction on financial statements. This is a video that is targeted to individuals who have no prior knowledge in accounting, and this is supposed to represent you with a summary on the main financial statements and why they are important. What we'll be going through today is I will be giving a brief introduction on the three main financial statements, and then I will be walking through on each of the financial statements one by one, namely the income statement, the balance sheet, and the cash flow statement. And finally, I will be summing up all the new knowledge that you hopefully have gained for the day. So let's move on to our first topic, the introduction to the three financial statements. The purpose of existence for these financial statements is to provide information on the financial position and the performance of a company. The income statement reports the financial performance of the company over a period of time. So it goes all the way from revenues generated from the sale of the products to the bottom line, which is the net profit generated by the company. Secondly, the balance sheet gives an overview of assets, liabilities, and equities for a specific time. That can be, for example, a day, 31st of December 2016 in our case. And finally, the cash flow statement provides a summary of all cash flows, cash inflows and cash outflows of the company over a time period. For example, a year, a month, or a quarter. Let's move on to the first financial statement, the income statement. I chose to speak about this first because this statement is the easiest one to get your head around to, and will be easier to follow later on how each item flows into the next statements. As I mentioned before, the income statement starts out with the revenue and ends with the result, which is the net profit. In the first slide, you will see an highlighted area, and this relates to all the items that we'll be talking about in this slide for your reference. First of all, we start with the revenue, which the revenue is the earnings recognized when products and services are actually delivered by the firm. This is regardless of where the cash on these items is received by the customer. So if the product has been delivered within this time period, in our case financial year 2016, then it will be recorded on the income statement. The second line item is cost of goods sold, which are per unit expenses of selling these services or products. For example, this could be cost of materials, cost of labor, generally costs that can be attached to one specific unit. And the first part, we end with gross profit, which is the profit that we earn on our sales once this cost of goods sold have been taken into account. And this is before fixed expenses like marketing expenses, rent on the offices and the buildings, etc., which we'll be looking at later on. As we move further down the line in the income statement, in the next slide, we're going to talk about operating expenses, D&A, which is depreciation and amortization, and earnings before interest and tax. So after the gross profit has been calculated, there are operating expenses to account for. These expenses, in contrast from the cost of goods sold, are expenses that cannot be directly linked to specific items. These are, for example, marketing expenses, research and development, that this go on for a longer period of time and cannot be attributed for specific units. You just cannot separate them. And the line after that is depreciation and amortization. This is a non-cash expense, which means that even though depreciation and amortization reduces the gross profit line, it is not actually a cash expense. What depreciation and amortization means is these are cost of assets that are being used over time. For example, when you purchase an asset, let's say a tangible asset, for example, a machinery, this machinery, as you use it over time, the value of the machinery will depreciate as it becomes more outdated and, yes, less useful. And this fall in the value in the tangible asset, in our case machinery, will be recorded, will be subtracted in the income statement. Amortization is the same as depreciation, but this is used for intangible assets, such as patents or copyrights. Then we move on to operating income, which is earnings before interest and tax. This operating income is calculated by subtracting the operating expenses and depreciation and amortization or other non-cash expenses from gross profit, and you come up with earnings before you've taken into consideration interest payments or taxes or other non-core activities. Let's move on to the next slide. The next item that we'll be talking about is interest income or other forms of income and expenses. In difference to what we have been talking about so far, these interest income and other forms of income are not part of the core activities of the company. For example, if a company sells Coca-Cola, then the sale of Coca-Cola is part of the core activities of the company. However, if the company decides to invest in real estate, it is not part of the core operations, or invest in debt, then of course it's not counted as part of core operations as well. And in this case, in the case of investing in debt, this company will earn interest expense or will earn interest income or expense, it depends, and this is where these items are recorded. And then we move on to pre-tax income or earnings before tax, which is calculated by subtracting other forms of income and expenses from earnings before interest and tax. So this is the amount, the earnings on which taxes are calculated. For example, you have a tax rate, you have the earnings before tax, you multiply this by 1 minus the tax rate to get down to the net profit line. The net profit line is the amount generated from both core and non-core activities of the firm. And this is the amount that is the bottom line that comes up after we have taken into consideration all forms of expenses, fixed expenses or variable expenses, as well as other forms of income and taxes. To provide a summary on the income statement of what we have discussed so far, I would like to repeat that the income statement is the statement that shows revenues down to the net profit line over a period of time, 1 year, 1 quarter, 1 month, etc. And the items, including revenues and expenses in the income statement, are only recorded if these items are being delivered in the period that we're taking into consideration, regardless and irrelevant if the payment from the customer has occurred. The rule according to accounting standards is that an item should appear on the income statement. For the item to appear in the income statement, they need to fulfill 2 main conditions. First, it must correspond to the current period. Only items that have occurred during the period that we're taking into consideration, for example, financial year 2016, will appear there. And also, these items have to impact the company's taxes. For example, issuance of debt by itself, the debt that you issue does not appear on the income statement because it does not affect your taxes. But the interest that you are receiving or from the issuance of or paying on the issuance of the debt, this will appear on the income statement as we previously saw. Let's move on to the second financial statement, which is the balance sheet. The balance sheet offers an overview of assets, liabilities, and equity. As you can see in the slide, assets first of all represent what the company owns, its resources, and these resources will increase cash flow in the future. Assets are divided into current assets and long-term assets. We'll explain what these are later on. Liabilities, these are obligations or debt-like items that are used to fund the assets, and these will reduce cash flow in the future. And finally, equity, this is a funding source as well and relates to funds that are raised internally. So in difference to debt, for example, equity includes items like the money that owners of the company have put in the company without having to borrow in order to purchase these assets. And as you can see from the equation, assets should always equal liabilities plus equity. So the resources of the company should always equal the funding sources that have been used to purchase these assets. We move on to the second slide, where we'll give an overview of the asset side, more specifically on current assets. The current assets are items that can be sold for and can be sold and turned into cash within a year. So these are highly liquid assets, and they include cash and cash equivalents, short-term investments, accounts receivable, prepaid expenses, and inventory. These are the most common items, which I have decided to include here for our purposes. So to start with cash and cash equivalents, this is either physical currency or very highly liquid investments, for example, notes or treasury bills that can be easily sold and turned into cash almost instantly. Then we move on to accounts receivable. As we mentioned before, all the items that are recorded in the income statement are items that that relate to the company actually delivering its product or service within the period that we're taking into consideration. Now, accounts receivable arises when the company has delivered its product or service, but it has not received the cash yet from the clients. And in this case, it is an asset because it will increase the cash flow in the future as you get payments for the services that you have already offered in the past period. We move on to prepaid expenses. These are expenses that are to be incurred later on, but the company chooses for some reason to pay these expenses beforehand. For example, this would happen when the company believes that by purchasing, for example, products in bulk from purchasing raw materials in bulk can give them a better deal than paying for these raw materials as the time goes by. Lastly, inventory is a very important item in the current assets. Inventory represents raw materials or materials that are in process or products ready to be sold that have not been sold yet and will be sold out in the future, and as they sold, they generate cash flows in the future. So these are also included in current assets. Then we move on to long-term assets, which in contrast with current assets, long-term assets cannot be easily liquidated. These are some forms of illiquid assets that cannot be sold at the moment in time to be turned into cash. The most important items here are PPE, which is plants, property and equipment, intangible assets, and long-term investments. Property, plant and equipment represent physical and illiquid assets, for example, land, building, machinery. that are vital for the company to perform its core operations. Other intangible assets, which is the next line item, this represents in contracts with property, plant and equipment, they represent intangible assets, not physical ones. For example, intellectual property like patents, trademarks and copyrights. Other intangible assets can be, for example, a very important item for pharmaceutical companies, which they develop these new drugs, and when they first bring the drugs into market, they have this new products that have gotten into market protected by patents, so that other companies cannot reproduce them as well. And finally, long-term investments. These are investments that the company has done. For example, in the stock market, they have invested in bonds, in real estate, etc. So now we're done with the asset side of the balance sheet. We move on to the liabilities and equity side. First of all, let's start with current liabilities. This is normally includes short-term debt that can be paid off within 1 year. Current liabilities includes short-term debt, accounts payable, and accrued expenses. Short-term debt, this evidently includes incurred debt that is due within a year. For example, small bank loans. Accounts payable is an item that relates to when the company has already delivered the items for a specific product, but they have not received, but they have not paid yet. So they have gotten what they wanted from their suppliers, but they have delayed their payment to the suppliers. This can be very normal occurrence, for example, with supermarkets. These supermarkets have very big bargaining power over their suppliers for groceries, for example, and they can afford to get the products first and then repay them later on. And this is a liability, of course, because this will reduce the cash flow in the future as you pay for this product. Accrued expenses is another line item that is very similar to accounts payable, but the only difference is that accounts payable relates to items that have specific invoices. For example, inventory payments, marketing services, etc. While accrued expenses relate to expenses like monthly wages, monthly rent, utilities like water, electricity, that don't have a specific invoice and don't relate to a particular item. Let's move on to long-term liabilities and equity side, but this time we'll be looking at long-term liabilities only in this slide. Long-term liabilities are items that you owe, that you have, is long-term debt that you have used to purchase your assets, but this long-term debt has a maturity of more than 1 year. The main items are deferred revenue, deferred tax liability, long-term debt, and finally we'll be discussing equity later. Deferred revenue is revenue that has a revenue that you have received already by your clients, but you have not yet delivered the product, and you will be recognizing this revenue later on. So this is deferred revenue, and this will be reducing your cash balance, because as you deliver the product later on, you will be not receiving money in later periods. So for you, this will result in a fall in your cash flow in the future. Now, deferred tax liability relates to the difference between the taxes that you have recorded in the income statement and the taxes that you have deferred. So there is a proportion of these taxes that you have not been paying in the past, and that you have deferred for future periods, and this will reduce your cash flow in the future. That's why it's a liability. And finally, we have long-term debt, which is incurred debt exceeding 1 year of maturity. This is relevant for big bank loans, for example, for mortgages on houses, on real estate, and for bonds as well. On the next slide, we move on to discuss equity. Equity is another funding source for the company, but this is an internal funding source. You don't go to outside investors to ask for money in terms of asking for debt, but you use money that is already in the business. This can be in different forms. For example, money contributed by the owner himself, the money raised by selling stocks from the company, to outside investors which choose to invest in the company, so they give you money and you give them ownership in the company. And also this can be a proportion of the net profit that you receive in previous periods. You decide to not let it run outside of the company, but you reuse this net profit to reinvest in the company and purchase new assets. Usually this equity line is more elaborate in real financial statements, but this is a summary and an introduction of financial statements. So for our purposes, I've only included one line in equity. So to sum up on the balance sheet, the balance sheet shows company's resources, which are assets, and how the company acquired its resources, which is through liabilities and equity. And the balance sheet shows the balance at a specific date or point in time. The main rule for balance sheet is assets should equal liabilities and equity, so the balance sheet should balance, because assets get acquired through either company savings, which get incorporated into equity, or by borrowing, which get incorporated into liabilities. And finally, the three main items in the balance sheet are assets, liabilities, and equity. Assets are items that the company owns, and this will result in future cash flows. Liabilities are borrowings that result in less cash in the future. And finally, equity is an alternative funding source to debt, and it refers to money being raised internally. The last financial statement is the cash flow statement. The cash flow statement tracks changes in the cash flow during a period of time. It takes into account cash inflows and cash outflows from operating activities, investing activities, and financing activities. Operating activities are changes in cash flow. Changes in cash flow from operating activities are changes that come from cash flow generated from core business operations. Cash flow from investing activities are changes in cash flow that are as a result of purchasing investments or spending on increasing the capital within the company. And finally, financing activities are activities that result in changes in cash flow from financing activities are changes in the cash flow from raising debt or equity. We'll be looking at these sections one by one as we go along. First of all, cash flow from operations. In this section, we start off with net income or net profit, as we say differently, and we track all the changes in operating items, which are normally current assets and current liabilities. We also take into account for non-cash expenses. So here we add back all expenses that do not represent actual cash expenditure, like depreciation and amortization that we subtracted in the income statement. Here we add it back because it doesn't represent us spending any money on operations. And lastly, we track the changes in working capital. these are changes in current assets and current liabilities. And finally, we come up with the cash flow from operations. We move on to cash flow from investing activities. These usually, most of the time, the most important items are capital expenditures and purchases or sales of short-term and long-term investments. Capital expenditures are spending on long-term tangible assets, for example, purchasing machinery. And then purchases and sales of short-term and long-term investments represent the extra cash that is spent or received on you investing or selling these long-term investments. On the next slide, we'll be moving on to cash flow from investing activities. The main items here are capital expenditures and purchases and sales of short-term and long-term investments. Capital expenditures represent spending on long-term tangible assets, for example, purchasing machineries, buildings, plants, etc. And then purchases and sales of short-term and long-term investments represent extra cash that is being spent or gained on the investments that the company has done, for example, in the stock market or the bond market. Lastly, we move on to the next section on the cash flow from on the cash flow statement, which is the cash flow from financing activities. Cash flow from financing activities includes mainly debt and equity issuances. This debt and equity issuances include items like debt and equity used to fund business operations. And these items usually increase the issuances and the debt raised, increase the balance of the cash flow. And lastly, we move on to the last line item in the cash flow statement, which is the ending cash balance. And this represents this is the final cash balance after having accounted for cash changes over this period. So far we have been looking at cash changes over the specific period that we're taking into consideration, from the 31st of December 2015 to the 31st of December 2016. And this balance is added to the beginning cash balance to come up with an ending cash balance. In our case, the beginning cash balance is 0 because we are assuming that the company has started operations this year. So to provide a summary on the cash flow statement, the cash flow statement tracks money inflows and outflows over a period of time. This includes cash flows from operating, investing, and financing activities. The cash flow exists for two specific reasons. First of all, it adjusts for non-cash revenues and expenses on the income statement. As we mentioned previously, in the income statement we have subtracted depreciation and amortization, which are not real cash expenses, so we need to add them back in the cash flow statement from operating activities. And secondly, in the cash flow statement, there may be additional cash inflows and outflows that do not appear in the income statement. For example, capital expenditures that we saw before. They do not appear in the income statement because these capital expenditures do not affect taxes, and that's one of the main two reasons why an item should appear on the income statement. So in this case, it doesn't, and we account for it in the cash flow statement. So we are done with the with providing a quick overview on the three financial statements: the income statement, the balance sheet, and the cash flow statement. Just to provide a review on what these statements mean, a sum up. The income statement reports revenues, expenses, and taxes over a period of time. like 1 year, 1 quarter, 1 month, etc. And it begins with total revenues all the way down to the after-tax profit or net income. Secondly, balance sheet. The balance sheet shows the company's resources, assets, and how the company acquired these resources, which is through liabilities and equity. And this shows the balance only at a specific point in time. In our case, the 31st of December 2016. Finally, the cash flow statement. It tracks money inflows and outflows over a period of time. Includes changes in cash flow from operating, investing, and financing activities. I hope you enjoyed this video and found it useful. Thank you very much for listening, and next we'll be looking at still the financial statements, but how these three financial statements are linked together. Thank you.